earnings per share. So when we talk about earnings per share, we are going to be looking at the allocation of the profit that a business generates for that particular period on the number of shares available. So we are looking at how much each share in a business will earn with respect to the profit that the business has generated. So this is an indicator of how efficient a business is, because the more a business generates in terms of profit, the more each share earns. It is different from dividend per share, because the profit that is generated, a portion of it is paid out as dividend. So that dividend is what is spread over the shares. But here we're looking at the profit in its entirety. Now, this is important because investors need to know whether the business has the potential, either now or in the future, to generate enough profit for it to allocate on the shares. So the allocation on the share can determine how much dividend they will receive, or how much they are likely to receive when they want to transfer or sell off the shares. So it's also important because it determines the business's stock price. If a business generates more profit, its stock is going to be higher on the market because they're performing well, and vice versa. If they're generating low, it will affect the stock price. I mean, it's in conjunction with other factors, but we are looking at this in particular. And lastly, it determines the future performance of the stock or the share. If a business is generating more profits now, it is safe to say that they will continue to exist in the business. Let's look at challenges related to earnings per share. The first is that, as always, cash flow is a better judgment of a business's performance than profit, because cash flow determines the actual ins and out of cash. Profit is first based on accrual. Monies that are earned are recorded not because they've been received. Monies that are incurred are recorded not because they've been paid. Certain items are also recorded to determine profit. Also, profit is at the behest of management to manipulate to achieve their purpose. They can generate more revenues on credit just because of a particular purpose that inures to their benefit, but is detrimental in the long term. Earnings per share is not a sure indicator of the business's performance. They might be suffering now, but something can come around in the future for them to pick up. So there has to be careful analysis to determine whether this can be used to determine the future state of the business. Let's look at the formula of earnings per share. So the formula is the profit for the year, then we deduct preference dividend. We've already spoken about preference dividend when we were dealing with dividend per share. We are looking at the earnings that is attributed to the common or ordinary holders of the business's equity. And we divide it by the average number of shares, or we just find the total number of shares available. Okay. Now, to make a meaningful analysis of the business, we must be compared to the prior year of the same business, to competitors of their choosing, or an industry set metrics. Now, when we do so and it is higher, it means that the business had a relatively higher profit than the comparative figure. Okay, due to maybe higher revenue they sold or management of their expenses that led to that. This can also mean there is increased yield for investors. The shares will have more profit allocated to it than before. This will also affect the amount of dividend that can be paid, because if there is higher profit and the payout ratio is, let's say, 40%, the 60% will be higher than when there was a lower ratio. Now, on the other hand, when you make the comparison and it is lower, the indication is that there was a reduced profit. It also will mean that there was an increase in number of shares with the profit staying static. If the denominator increases, the resulting figure will decrease. Maybe they floated more shares, they brought in more shareholders, but it didn't reflect in the performance of the business to have a commensurate increase in the profit. It also will indicate a reduced yield for investors. The earnings per share will go down, which might even affect the dividend per share. Let's test our understanding. So here is an extract of the statement of profit or loss for the year ended 31st December 2019 for a certain business. So we have the revenue, the cost of sales, leading to the gross profit. We have the operating and administrative expenses, then operating profit, interest, profit before tax, the tax, then the profit for the year. So in additional information, we have preference shares dividend paid for the period was 500,000. Then 600,000 ordinary shares were also available. The earnings per share for the industry was 18. So we are now to calculate and interpret the earnings per share for the period. So we are now going to compare to a set industry metrics. So for solution, we state the formula, which is profit for the year minus the preference dividend divided by average number of shares, or you can just take the number of shares for that matter. So when we do the calculation, we are going to get an earnings per share of 21.83. This was as a result of dividing the difference of the profit for the year of 13,600,000 and 500,000 preference shares dividend by the ordinary shares available of 600,000. Okay, so when we interpret this, it will mean that each share has an allocated earning of $21.83. Now the shares earn more than the average because the metrics was 18 and now we have 21.83. So it did well. It also means that the business is sound financially on the face level. Now details must be sought to find out whether there was no underhand dealing in the generation of the profit. Because if the business now can generate more than what the industry expected to be, that means that the future is bright. Okay.